How to use DSCR loans to invest in real estate. This is a free course. Hey, what's going on, everybody? It's Jeff Trevarthen, Jeff the Mortgage Pro. Hope you're doing really well today. Thanks so much again for watching. What I thought I'd do on this video is put together a kind of a mini course for you to be able to go from start to finish with the DSCR loan. And so I'm going to break down several of the different ideas that I have for what you should do first, what you should do during the process, and then even what you need to do after your transaction closes. So before I jump into it, if you would do me a huge favor, if you really like these videos, please go ahead and click the like button down below. And if you really want to see when my videos come out, I'd love to have you as a subscriber, as part of the community here. So go ahead and hit that subscribe button and you'll be notified hopefully when those videos come out next. But thanks again for watching my channel. I really appreciate it. All right, let's jump right in here too. So we're going to talk first about the basics. So first of all, we want to know what a DSCR loan actually is. So DSCR stands for debt service coverage ratio. And what does that mean? It's pretty simple math, really. It's just the gross rental income that you have on a property divided by the mortgage payment, including the principal, interest, taxes, and insurance monthly payment. And if there's a HOA in there as well, that would also be added to the principal, interest, taxes, and insurance monthly payment to determine that. So debt service coverage ratio, the gross rental income divided by PITI, including the HOA if there is one. Okay. So most lenders are going to require, especially if you're going to buy your first property as an investment property, even as a seasoned investor, that we're typically going to want 1.0 ratio or better. That means that the property is going to cash flow going forward. So these are important metrics to know before you actually even get going on the whole process to figure out if you can buy a property with a DSCR loan. So 1.0 or better. If we can get the DSCR to 1.25 or better, that's going to give us the most optimal pricing. And then going forward, that means more cash flow for you. In some instances, I've seen upwards of 2 for DSCR on specifically like short-term rentals and things of that nature. Oftentimes, like multifamily property, 2 to 4 units is going to have higher debt service coverage ratios going forward. So consider the property type that you may want to buy as well. Okay. Know that the property is property-based, not income-based. So that's the great thing about the debt service coverage ratio loan is we're looking at the income of the property itself, not the income for you as a potential borrower on this loan. So I have clients that have no jobs. I have clients that are first-time investors, but they have the assets to be able to do these types of loans. I have investor clients that have 100 properties or more. So I work with a whole gamut of people in doing these types of loans, but just know that you don't need any traditional type of income whatsoever because we're using the income of the property itself. So, in terms of documentation, that means no W-2s, no pay stubs, no tax returns, which is a big one sometimes. So just know that these loans are property income based, not personal income based loans. So I think that's a really, really good thing with these loans to help people qualify for them. Okay, number 2, what I want you to do is check your investor profile. And what I mean by that is that we want to try to aim for a minimum credit score. We can do DSCR loans down to like 640, 660 credit score, but if you have a 680 credit score or better, that's going to be the most ideal. A lot of lenders cut it off at 680. Ideally, we want you to be, 740 or higher on these types of loans for your credit score. So if your credit is on a little bit on the low end, maybe that's something that you want to work with. Try to improve that a little bit before you actually get going on getting yourself a DSCR loan going forward. So you want to be prepared in terms of down payment to probably put anywhere from 20 to 25% to be able to purchase the property. The amount of down payment is going to depend on several factors: credit, how much you have for a down payment, what type of property it is, what's the debt service coverage ratio, and all those things are going to matter in terms of down payment. But we can, for the most part, most people can get away with 20% down on the purchase of the property. If the property is not going to cash flow, you got to ask yourself a question. Is it really a good investment for you going forward? I mean, I don't know if that's the goal, right? If you're trying to get cash flow on a property and it doesn't cash flow right out of the gate when you're running your numbers, most people would just say, hey, nope, we're moving on. We're going to go find another one, because there will be plenty of opportunities out there to find, the ideal property for you when you're looking for an investor property. Okay. And the third part of this one is that I want you to make sure that you keep anywhere from 3 to 6 months of reserves as a minimum So what reserves are is just the monthly mortgage payment, principal, interest, tax, and insurance, and HOA multiplied by however many months of reserves we need. So for example, if the principal, interest, tax, and insurance monthly payment is $3,000, let's say, and a 3 months reserves, we would need $9,000 left over after the transaction's done. Now, this is going to do two things. Number one, it's going to give you a little peace of mind and security because maybe you're buying a property that doesn't have a renter in there already. So you might have to spend some time to try to be able to get the property rented out. So that gives you a little bit of leeway, as well. But also at the same time, it gives the lenders a little bit of security as well, because reserves are just a risk calculation for lenders. We want to make sure that we have enough, residual money left over after the transaction's done, so that they feel confident that you're going to be able to make the mortgage payment should, you not have a renter for a month or two going forward. So that's what reserves are. But I want you to make sure you have at least 3 to 6 months worth of reserves, preferably more if you can. It depends on the price of the property, how much in reserves you need, but I would say 3 to 6 months is a good place to shoot for. Okay. The third thing that I want you to do when you're trying to get a DSCR loan to invest in real estate is to identify the right type of property. So when we're doing DSCR loans, there's two different types of properties you can look at or consider. One of them is called a long-term rental. That means that somebody is there for probably a year or more, and that can turn into a month-to-month lease after the person's been there for a long time. That's usually not an issue, but in general, we want to see a year or more in terms of a lease agreement for a long-term rental of a property. And then the other type of property that we could look at is what's called a short-term rental. And that's usually going to be on a nightly basis, maybe a weekly basis, whatever you want to do in there. But what you'll notice is that a lot of investors are considering what are called midterm rentals right now. So midterm rentals are great as well. Those could be like to traveling nurses or doctors, business people that need to be in certain places for, kind of an extended amount of time, maybe 2 to 3 months, but maybe not longer than that. The only problem is with DSCR loans, they're either short-term rentals or long-term rentals. There's no in between. There's no midterm rentals for that. So when you're purchasing a property that you want to turn into a midterm rental, you would want to consider, hey, is this going to be suited easier to get a loan with a long-term rental, and can we make it work that way, or can we make it work with a short-term rental type of a loan going forward? So you got to kind of weigh those options, and I would be somebody that would be happy to help you decide on what you want to do and how you want to structure the loan going forward. So identify the right type of property that you want to do for whatever type of rental real estate you're trying to acquire. The second thing is confirm with lenders which property types are eligible. So, obviously single family homes are typically eligible, townhomes, 2 to 4 units, sometimes condos. Condos are definitely getting harder to do, especially in certain states where regulation is getting harder and harder to get through, HOAs and things of that nature. So it could take a little longer if you're doing condos. And then you can also do like multi-unit properties that are beyond the typical 1 to 4 units. You could go 5 to 10 units when you're looking to buy a property with a DSCR loan, but those are going to require experience going forward. And each lender has a different type of experience that they would say. Okay. You can also look at like condo-tels, which are basically non-warrantable condos. There's other forms of non-warrantable condos, meaning that maybe they have too many investors for traditional type financing that you could get on a property. So that's another thing that you could definitely look at purchasing when you're buying these types of properties with these loans. But just make sure that you have an idea of what you're looking forward, to get going on using the DSCR loan to purchase investment real estate. And you want to definitely look for areas that have strong rental demand. That's a big thing, and definitely appreciation potential. What I often see across the United States is there's different types of markets. You have markets where you can really bank on appreciation. So examples of those might be Orange County in Southern California, San Diego, the Bay Area. Those markets are really, really hard to find cash flow type of real estate. But what you can probably bank on for those, and I hate saying this, but real estate tends to go up in those areas. And I know the whole adage of real estate always goes up, and not really, but for the most part, most of those areas are continuing to see growth year after year in value, and it accelerates pretty quickly because of the price of the properties are so high. Just a small increase can be a big amount of equity that you gain in those types of properties. So that's one type of market. The other type of market that I see is, very strong cash flow type markets. So, markets in Tennessee, Ohio, Indiana, Georgia, Florida, Alabama, Pennsylvania, those are all type of markets that tend to have not as much appreciation. So the values of the properties don't go up, but you're going to have really good rental income because there's a strong demand for rental real estate in a lot of those markets all across the country. And I'm not listing every single one of them that I could ever think of. That's just, some of the ones that I was thinking of off the top of my head. So rarely do we ever find markets that are both appreciation markets and great rental cash flow markets. So you got to kind of judge which one you are banking on when you're trying to get these loans for DSCR loans, because it matters, what lender we would take this to and how we would structure the loan so that you could, be able to acquire the property and do what you want to do with it going forward. Okay. All right, next, we want to make sure we analyze the cash flow of the property going forward. So we want to use realistic rents, so actual leases or appraisers' market rental schedule. So this is often the hardest part of buying rental real estate, is estimating what we think the potential cash flow of the property is going to be. So when we're doing DSCR loans, we are looking at just the gross income and just the expenses of the mortgage payment going out. And you'll know if you've ever invested in real estate before that there's other expenses that you have to consider beyond just the mortgage payment on the property. For the loan purposes, all we're looking for is the income coming in to be greater than the expense of the mortgage payment going out. But in reality, sewer, gas, water, trash, all those different things, maintenance on the property, those things can all factor into the decision of whether this is a good piece of real estate investment or not. So we have to do a really good job of trying to estimate what we think the rental income is on the property going forward. For example, one of the hardest things to do is to determine what rental property is, especially if there's not a lot of comparables in the area. So you would really want to do your homework on things like that. For short-term rentals, it's a little bit easier because we often can use AirDNA. If you've ever heard of that before, that's a service that allows you to see what the potential rental income of a property is. It'll give you about how much occupancy they anticipate per month, and then it'll also give you what the rental income should be depending on how many bedrooms and bathrooms the property has. So AirDNA is a fairly reliable indicator of what the future potential rental income of a property might be using short-term rentals. So Rentometer is one that you can use for the long-term rentals. Oftentimes that gives you a pretty good idea of what the market rent is before you can actually get into the transaction. So definitely want to analyze the cash flow and figure out exactly how that's going to work before we get into the transaction. So again, don't forget any other of the expenses like HOAs, because those things could potentially eat into profits, utilities, insurance, taxes. All those things are going to matter when you're actually getting a loan for a DSCR loan and you're buying a property. Because again, the goal is probably going to be cash flow for you. So how much cash flow are you going to get on a monthly basis for the money that you're investing? That's really important. So we want to try to target properties that are going to have a 1.25% 1.25 DSCR ratio or higher. That's going to be something that's going to give you plenty of room to pay for those other expenses and whatnot going forward. So 1.25 or better, but we can still do loans, even at a 1.0 DSCR ratio. That's usually the minimum. But remember, there's products out there that are called no ratio. That means that they can go under 1 for the debt service coverage ratio. And again, those might be used in markets that are appreciating, like we talked about earlier, versus cash flow type of markets. All right, number 5 in our course here about how to use DSCR loans to invest in real estate is we want to shop different lenders and programs. So I can help you do that as a mortgage broker. I have access to more than several different lenders that will fund DSCR loans. And after doing this for several years, I've got a pretty good grasp on the ones that are going to give us, number 1, pretty good rates, number 2, really good service, and number 3, they're going to be able to close your loans in a timely manner, which is also important when you're going to be able to purchase property, especially given the contractual timeframes that we often have that we're working with. We want to make sure that we watch out for prepayment penalties. And this is something that DSCR loans come with. And I always want to make sure that people know that, because these types of loans allow you to have prepayment penalties on them. So we can do anywhere from no prepay all the way to a 5-year prepay on our DSCR loans. And that no prepay is going to give us a higher end of the rate spectrum. And then the 5-year prepay is going to give us the best of the rate spectrum. So the way that you can kind of look at it is that prepayment penalties kind of protect the lender. So lenders typically don't make a profit on the interest that you pay until at least 3 years of paying interest on a loan. So if you can do 3 years or longer, that's going to be the best of the interest rates. Even 5 years is going to be even better than 3 years. But if it's something that you may end up refinancing at some point in the next year or two, or if it's something you might turn around and sell in the next year or two, then you want to go with a higher interest rate and go with a shorter term prepayment penalty. So just be aware that DSCR loans have these on there. And the reason they can is because they're considered business purpose loans. So they're definitely not like conventional qualified mortgages. They're called non-QM, non-qualified mortgages, just because of the different ways that they allow you to qualify for these types of loans. And then make sure that you work with somebody that has experience in doing these. I've done hundreds of these loans over the last couple of years. This has become my niche. This is what I know. So if you have any questions at all and you need some help with, somebody that can help you with your DSCR loan going forward, then I'm your guy. Okay. All right. Number 6 in our mini course here is prepare your documentation and get it ready to go. So what type of documentation that we need? So it's a lot less than what we would do if we were doing a conventional loan, because remember, we're not looking at your personal income. We're just looking at the income of the property itself. So things that we're going to use to get you pre-qualified, we're going to use your assets. So we're going to need the last 2 months worth of asset statements. So asset statements could be bank statements because it could be in your savings or checking account. You could have stocks because all of your money's in stocks. I'm even seeing some lenders start to allow us to use crypto for this type of things. Not necessarily for the down payment. It would probably have to be converted to cash, but you can also use those types of things. So just a heads up that might be coming down the road going forward to be able to qualify for DSCR loans. So just be aware of that. You're going to need to get, when you're getting your loan, you're going to need to get insurance quotes. Definitely going to get HOA documents if you're dealing with condos or townhomes or PUDs that are in an association. We need to get those documents coming forward. And then again, we need to have proof of your reserves and down payment going forward. Another thing that you might want to start gathering too is that a lot of people close these loans in LLCs. So you would want to get your entity paperwork going ahead of time. Typically, it doesn't take very long to get your entity paperwork in reality, but if it's something you want to do to make sure you get prepared for it, then by all means, go ahead and do that and get those LLC documents. That means the EIN tax document, that means the operating agreement, that means the articles of organization. And then if it's an established LLC, you're going to need a certificate of good standing from the state in which you're working in for these types of loans. Okay. All right, number 7 here on our free course of how to get a DSCR loan is structure your financing strategically. So what I mean by that, you want to decide which type of loan do you want. Do you want a 30-year fixed amortization on something? Or do you want maybe a 5-6 ARM on there, which is going to have a lower interest rate to begin with, and potentially make the cash flow better, and then in 5 years you would reevaluate and figure out what you want to do going forward. Do you want to refinance or do you want to keep it there? You can also look at doing extended amortizations. So for example, there's some lenders that will allow us to do a 40-year amortization on these types of loans. And then even on top of that, do we want an interest-only option going forward? So these loans are typically interest only for 10 years, and then they would adjust to a fixed rate mortgage after that. So for example, if you got a 30-year fix with a 10-year interest only loan, the first 10 years you're paying interest on the loan, and then on the month after the 10-year mark, you're going to get adjusted to a 20-year fixed mortgage, 20 fixed amortization to pay off the loan in 20 years after that. Or, more strategically, maybe you go with a 40-year interest-only loan with the first 10 years are interest-only, and then after that first 10-year period, then it turns into a 30-year fixed mortgage after that for 10 more years. So if you're really banking on cash flow, then there's lots of tools in the toolbox here to be able to help you out, figure out which type of loan is going to make the most sense for you. Okay, so I never want to make that decision for you. It's important to consider though, like what's the lowest payment? What's going to give me the most cash flow? So when you're looking at property, consider the different options that you have to structure your financing differently or appropriately to make the property cash flow as much as possible. Okay, number 8, we want to close and then stabilize the property. So what does that mean? We want to make sure we do a very thorough inspection of the property. You can do this with your real estate agent or a contractor if it's potentially going to need some work that you're doing on the property going forward. So do that before you actually close on the transaction so that there's no surprises, once you actually own the property and you're able to go in it when it's yours, not somebody else's. You want to secure your tenants as quickly as possible on these types of things. Just remember that when you close a mortgage loan, mortgages are paid in arrears. So you paid prepaid interest when you close from the date of what you close until the end of the month. And then your mortgage payment isn't due until the following month. So for example, what I mean by this is, let's say you close a loan on the 15th of a month. And at closing, you're going to pay prepaid interest from the 15th of the month till the end of the month there. Your first payment is not due the next month. It's due the following month after that because mortgages are paid in arrears is what it's called. So it's important to get a renter in there as soon as possible so that you can start getting income before you actually have to start making mortgage payments, if possible, going forward. And then you want to make sure you set your rents competitively in the market. Maybe you don't want to be on the very, very high end. It might take longer to get it rented out. Or maybe you don't want to be on the very, very low end because you might get somebody in there too quickly where you could have got, another couple $100 more per month than what you're renting it out. So make sure you set competitive rents when you're trying to find your property. And that's what I mean by stabilizing it, is getting somebody in there to start paying you rent so that it covers your mortgage payment and then hopefully gives you a little bit of profit beyond that. Okay. Number 9, we're going to monitor the DSCR performance. So we want to track income, expenses, and vacancy of your property going forward. It's pretty easy to do. You can just do it in QuickBooks. You could do it yourself. You can even have a property manager do it for you if it's something that you want to hire someone to do that for. You can even hire a bookkeeper to keep the books on your rental property if you really wanted to. So lots of ways to do that. We want to always try to increase that DSCR. So can you find ways to increase the income potential of the property? So for example, could you increase rent? Is there a space on the property where you might be able to charge for storage? Those things are little minuscule details, but they can also help you produce more income and more cash flow going forward on the property. You want to use performance reports to position yourself, for future refinances or potentially new acquisitions going forward, with that increasing the income on the property going forward and decreasing the expenses as much as possible. So those are definitely some of the things you want to do after you acquire a property. Just definitely monitor the performance of that property going forward. And then lastly, what we're going to do when we're trying to figure out how to use DSCR loans to invest in real estate is we want to rinse and repeat the process, right? So we don't want to just buy one. That's a lot of risk, just having one property and having X amount of cash flow. And if something happens, then that cash flow turns off and now we're not able to bank on it. So the more doors, quote unquote, that we can stack up going forward, the less risk each property becomes. Okay. And what I mean by that, so let's say you're buying a 4-plex or a 4-unit property, and then somebody else is buying a single family 1-unit property. Okay. If you rent out that single family property and then all of a sudden that person stops paying rent, that property is now 100% vacant and 100% is on you to make that mortgage payment every month. If you buy a 4-unit property, you are now, let's say one person decides to stop paying rent or decides to move out. Now, 3 out of the 4 units are still producing income for you. So only 25% of the property is vacant. So the same principle applies. The more properties that you own, the more quote unquote doors that you own, is that the risk is declining as you acquire more and more cash flowing properties going forward. So why would you not want to repeat this process over and over again? Okay. So once you stabilize the property, leverage the equity through cash out refinances, if possible. Depends on how much, is available for you. If you just bought the property, it's going to take a while for for you to acquire rental real estate going forward with that same property. But if you've owned the property for a long time, maybe it's owned free and clear, it's easy to do a cash out refinance on it with a DSCR loan and reinvest those proceeds and start acquiring more properties and decreasing that risk for yourself over time for cash flow going forward. I would suggest always using these DSCR loans flexibility without having to have any income. Like you literally just need to have the down payment, cash to close in reserves, decent credit, and maybe even just a little bit of experience, and you could really do really well with these types of loans, these DSCR loans. And lastly, build a repeatable system. I can't even talk anymore. Build a repeatable system. Buy the property or analyze the property first. Buy the property, stabilize it, get somebody in there with a rental income, refinance it, and then reinvest in it going forward. Okay. So that's my little mini course here on how to use DSCR loans to invest in real estate. I hope that you found this valuable. If you do, please go ahead and reach out to me. I'm gonna go ahead and put my calendar link down below. I'd love to be the one that helps you with a DSCR loan going forward. And thanks again for watching. I look forward to chatting with you on the next show. Have a good day.